the arithmetic has changed. Even the junk bond index, which is to say an index which requires you to take credit risk, is yielding 4.7 in a world where your savings are depreciating in purchasing power by 6.5. Take away 6.5 from 4.7, and you get a negative number, which means you have to pay to take the credit risk. The questioner's question is fantastic because it really changes the way people will be forced to invest. The largest institutional investors in the world traditionally have had 40% of their portfolios in debt. Now they're confronted with the fact that 40% of their portfolios are causing their beneficiaries, the retirees, the universities, whatever, to lose money on a guaranteed basis. I don't know what the outcome will be. I don't know when it will come, but I do believe it will be profound. Understand that we have to undo 40 years of training. The period 1982 to 2022 has been a very benign period, but unfortunately that part of the benign period is over. When more and more individuals say to the financial services industry, you know what, I don't want to pay you a fee to lose money, then the institutions will change. Right now, they sell the easiest thing to sell. And the easiest thing to sell is the supposed safety of fixed income obligations. The truth is that investors want income. Increasingly, the investing public, that part of the investing public that has money, is old, and those people want income. And they think, unfortunately, that what they want is relevant. What's relevant is what you can have. There is lots of income around there in passbook savings deposits, as an example, that yield you 25 basis points. But getting paid 25 basis points in a world where your currency is depreciating by 6.5% is obviously problematic. What investors haven't gotten around to figuring out yet is that even by taking the credit risk associated with the high yield bond index, or some of these leveraged mortgage funds that are yielding 4.5 or 5%, that even taking credit risk, they aren't keeping pace with inflation. Understand, too, in some of these leveraged mortgage funds, Dunnigan, what the investor doesn't understand is the way that they're getting this 5.5% yield is that they are buying 30-year 3.4% mortgages, and they're funding it, or the fund manager is, by borrowing money in the money market, in the overnights. In other words, they're borrowing 90-day money to finance 30-year money. If the short-term interest rate goes up or that credit becomes unavailable, the yield on those instruments goes sub-zero. The first thing that has to happen probably is that one of the big leveraged mortgage REITs has to go upside down. There has to be some circumstance where the time spread, which is to say the carry trade involved in borrowing short and lending long, causes people pain. I think as soon as that happens, that the behavior changes very, very, very rapidly. Every time I ask investors if they're happy with their existing banking relationship, every single time, the answer is no. And every time I talk to a sophisticated depositor and I say, how do you feel about the fact that these lending institutions are borrowing money in the overnight market and lending it for 30 years and living on the time spread? Does that make you feel comfortable? And they say it makes you terrified. Now, I maybe pay better attention to this than other people, but the fact that the circumstance is so dire that a 68-year-old who's allegedly in retirement is starting a new bank tells you that behaviors are and will change. I just can't tell you when. I think that silver is increasingly being viewed as a strategic metal, although perhaps not by the general public. If the gentleman is referring to a strategic metal in a non-monetary sense, that is to say its use in microelectronics and particularly its utility in solar power, understand that these solar panel arrays don't work without the reflective property of silver. Silver is already coming to be recognized in that fashion. With regards to investor appetite for silver, I believe myself that the current Silver Fan Club still views silver as a monetary rather than an industrial material. And I would point out to that crew that, at least in my lifetime, in the two precious metals bull markets that I have enjoyed in my lifetime, that silver is a late, which is to say the first half of a bull market is normally dominated by gold, the second half by silver. The silver market is more of a momentum-oriented market. The gold market is more of a fear-oriented market. So those people who are wondering why, with inflation at a nominal 6.5% and probably really at a higher percent, why the silver price hasn't moved yet, need only consult the 1970 to 1981 bull market, where silver was a very late mover, or the 2000 to 2011 bull market, where the same circumstance happened. When the circumstances behind the reason that I think it's going to go up change. So let's examine those reasons. We've done this before on your show, but I know that your viewers cycle. The first reason why I believe precious metals are going to go up, and understand that the principal reason, in my experience, why precious metals prices escalate is because investors and savers are concerned about the purchasing power of other savings and investment instruments, particularly those denominated in fiat currencies. So let's figure out why people might be afraid. The first is quantitative easing. We've talked about this before. Quantitative easing, the fact that 35% of the dollars in circulation have come into existence in the last 2.5 years. Quantitative easing is counterfeiting. It isn't like the economy's grown by 35%. We didn't need to accommodate an increased float of currency because of increased economic activity. We did it by creating more specious currency units. This is counterfeiting, and increasing the supply of something, in particular the spurious supply of something, lowers its unit value. Pretty obvious. The second is more pernicious, even more pernicious, pardon me. That's debt and deficits. Even now, the government concedes that the federal debt isn't going to be paid. It's going to be rolled over. And the numbers are alarming. The on-balance sheet liabilities of the U.S. government are almost $30 trillion. $22 trillion net of the Fed's own counterfeited balance sheet. But the off-balance sheet liabilities exceed $120 trillion. So the federal government, not state and local governments, the federal government owes $140 trillion. And they propose to pay this debt with a budget that's $3 trillion in deficit. In other words, rather than pay it down, they're going to increase it by $3 trillion a year, at least, compounded over time. This presents a credit risk, which nobody talks about. But it certainly causes other risks in terms of the stability of the currency. The third, and probably from a saver's point of view, the scariest, is negative real interest rates. If you buy the world's premier savings instrument, which is the U.S. 10-year Treasury, the deepest and most liquid security in the world, the arithmetic works like this. The government pays you about 1.6% currently a year for 10 years. Absolutely positively, this is going to happen because, remember, they can counterfeit. They can print what they pay you back.